We have a very busy week ahead of us, even if it's just 4 trading days long, thanks to the VE Day bank holiday on Friday the 8th of May. The main macroeconomic feature of the week will be the Bank of England's latest policy meeting on Thursday the 7th. Remember that in March, the UK's Monetary Authority unveiled a range of measures, including 2 cuts in the base rate from 0.75 down to 0.1%. Term funding to banks and building societies are at that rate of 0.1%, so they could in turn provide cheap loans to those that need them. A £200 billion increase in quantitative easing to take the total to £645 billion, and plans to get credit directly to companies that need them owing to the COVID-19 crisis via the CCFF, or Covid Corporate Financing Facility for larger firms, and the CBILS, or Covid Business Interruption Loan Scheme for small to medium enterprises. Via the Prudential Regulatory Authority, or PRA, it's also leaned on the big banks to suspend dividend payments and share buybacks so they can lend more, or at least better withstand any hits from loans gone sour. The PRA has also tried to cut the banks some slack on the bad loan front by permitting them to treat COVID-related loans more leniently, and so they don't have to book provisions and losses for possible losses too quickly. Now, it'll be interesting to see what the Bank of England's assessment is of this policy package, how effective it's been, and whether any of the elements of it need to be dialed up or dialed down. Turning to company news, around a fifth of the FTSE 100 released trading updates, results, or hosted the annual general meeting for shareholders last week, and pretty much the same numbers due to do so in the coming shortened week, with a few mid and small caps getting on the action as well. Names which may be of particular interest could include the following. On Monday the 4th of May, Rightmove hosts its annual general meeting. Then we get results from tobacco giant Imperial Brands and B&Q on a Kingfisher on Tuesday the 5th, followed by Smith & Nephew, ITV, Virgin Money UK and One Savings Bank on the 6th, and then Barrett Developments, International Consolidated Airlines, Coca-Cola Hellenic Bottling, RSA, and doorstep lender Provident Financial on Thursday the 7th, just ahead of the 3-day holiday weekend. But for me, the company most capable of causing a fuss in the week ahead is BT. The telecoms operator is due to report its full-year results on Thursday the 7th of May. It looks like a lot of investors have put the phone down on the company in the past year or so, despite the arrival of a new boss, former WorldPay chief Philip Jansen, in February 2019. BT shares are down by 48% over the last 12 months, during which time the FTSE 100 has fallen by just over a fifth. However, that recent share price slide can't be just pinned on wider market slumps that have come alongside the viral outbreak. In fact, BT shares now trade no higher than they did in their first week after privatisation in 1984. Now, this suggests the market is worried about how BT can compete on so many fronts: fixed and wireless telecoms, broadband, sports broadcasts, TV, when it has a lot of debt, a big pension deficit, and is hemmed in by the regulator Ofcom on one side, a host of competitors on another, and value-sensitive customers on another, all of whom are capable of switching from one service provider to another if they see fit. So, when it comes to assessing the numbers and whether BT can truly defend its profit and cash flow streams from these multiple challenges, analysts will look to 4 elements of guidance provided by Mr. Jansen last summer. A 2% drop in what BT calls adjusted revenues. That's the target. Adjusted earnings before interest, tax and depreciation, or EBITDA, is due to come in between 7.9 and 8 billion. Now that's up from a year ago, but the bulk of the increase comes from the IFRS 16 changes in accounting standards that relate to leases and depreciation. Then, look to what BT calls normalised free cash flow. That's due to come in between 1.9 and 2 billion pounds, down from 2.4 billion a year ago and 3 billion the year before that. Due to what it calls timing issues, BT has since steered expectations towards the low end of that range, which also includes capital investment of some £3.8 billion, down from £4 billion a year ago. On this subject of CapEx, analysts will be looking for colour on 5G mobile network spending plans and the impact of the row over whether kit from China Huawei can be included in the network or not. And finally, the fourth guidance, well, that's for an unchanged dividend of 15.4 pence a share. This might be the headline feature of the whole set of results, especially after France's Orange became the first major European telco to cut its shareholder distribution back in mid-April. For the record, the analyst consensus is for a small cut to 14.2 pence a share for the year just finished, then a bigger one to around 10p a share for the financial year just started. We shall see. Thank you for listening. I hope you and your families are all keeping well during these difficult times, and I look forward to talking to you again next week.